So what this paper is about, it's really consists of two parts. The one part is looking at the risk and return in the renewables in relation to petroleum. And the second part is looking at the project economics and then focusing on the German wind project early on, where with the fixed price regime that was in place there. So we do those two things, and I will run you through it. So I start with this confusing page, but that's really one of the portfolio that we looked at was really the Ardor portfolio, which is a new energy portfolio. And I looked at the beta of that for a portfolio to look at how does the risk compare to the petroleum. And as you see, it consists of very different type of companies, all away from Vestas, the wind systems, with the beta 1.2 at the top there, and with different betas through. And then I looked at the weight in the portfolio to weight it, and then the average is at the bottom, which is 1.1. So that is one way of looking at the beta and calculating the beta of the company is looking at the different betas of these type of companies. Of course, this will always be an approximation because these companies are very different in nature. Some of the companies are related to the service industry of wind. Some of the companies are making cars. As you can see, Tesla there is in the portfolio, has nothing to do really with, well, it has something to do with new energy since it's producing a lot of batteries. But in nature, the companies are very different. So as always, when you look at a portfolio, there it will be an approximation of what we would think of as a risk class concerning what we try to do is find out what is the beta of a company that is producing new energy from new alternative energy sources. So this is the first approximation. Then we have the second approximation, which is calculating the beta based on the portfolio itself. And here we have some different portfolio that we use the MSCI energy portfolio as the market proxy, and then we calculate these betas of these different type of investments. And I include Bloomberg Gold there just for a checking point. And we know that gold usually have a very low beta, and it also has a low beta in our calculations. I need to take down your view here because it's in the face of my presentation. Let's see there. As you can see, for the different periods, the beta varies across time. I've used the 3 different time periods from 2008 to 2019 for the whole period, and from the beta for the first period from 2008 to 2013, and then the beta from 2014 to 2019, and it's all calculated based on monthly returns. And as you can see, it varies slightly across the time, but it's basically in the same level, and that is what is important here. And if we look at the last period, we see that the beta of the alternative energy is 1.2. So it's very close to the 1.1, which I got from the quoted betas listed in the stock market. So I would say this is a fairly good approximation of what you would say is the beta of this portfolio. And as you can see, another Ardor portfolio, the solar, had a much higher beta, but it also had a much lower return. If you look at the green line, that's the solar portfolio. And then the blue above it is the Ardor portfolio. And then the red dotted is the energy portfolio, which basically is the oil and gas companies. And then the blue is the is the world index, which we are using as a proxy for the market portfolio. So, of course, these betas are including debt. So you have to take out the debt proportion of the beta to find an unleveraged beta. And if we do that, we see that the new energy beta is about 0.2 lower than it is for petroleum. So what that means is that that you would say that usually the oil and gas portfolios and companies are evaluated with a 10% nominal return. So a beta of about 0.2 lower would indicate a return that would be approximately 8.5% as compared to 10%. So you would have a slightly lower return on or requirement on new energy than you would have on the oil and gas, according to these numbers. The problem, of course, is that most of the new energy contracts or companies are using fixed price contracts. That is, they are given a price by the government and they can deliver power at that price. And of course, if you're not exposed to market risk related to your contracts, then you would require a much lower return. And for our second part of our analysis, we have used 6% nominal rate of return on those type of contracts, which is basically the German contracts that we will look at later, the wind project, offshore wind project. And the reason for that is that the German government gave the subsidized price, fixed price, for many years. They have now stopped using that. Now they have now a bidding contest for those type of contracts. But at the time, the producer were given a fixed price. And this was the fixed price they were giving. It was 15.4 cents per kilowatt hours for about 10 years. So we have used, and then it was 19 cents per kilowatt hours for the offshore project that was further long enough from the shore. So this means that during those 10 years, most of the return will be given to the company, because the next 5-10 years will not really matter that much in the economic valuation, because after those 10 years, the price will drop to 3.9 cents, which is a huge drop, and of course will not be sufficient if it had been given from the beginning to make these projects sustainable. So these are the projects that we looked at. It's listed here with the names on the left side, and then you see what year it was commissioned, from 2010 here in the middle to I've included a couple of other projects that basically the first until Arkona wind park. These are the German projects, and I included the Hywind Tampen, which is the floating project by the Norwegian government, which is really an Equinor project. And I also, by the data that I have gotten from the Empire Wind, which is the offshore New York project, I have included that as well. Of course, all these evaluation that I'm doing is really based on looking at the project from the outside. So we have to make a lot of assumptions regarding them. So these CapEx figures that are there are official numbers that I have found on the internet for how much investments were and how much power they were producing is basically the information that we got from that page. And those are the two starting points for calculating the economics: is how much was the investment and how much capacity electricity would they then generate. The second assumption you have to look at is how much uptime, how much, given the capacity they have, how much will they produce on average of that capacity during a year. And we have assumed 40%. Here is an IAEA analysis of how the project has been doing related to capacity. And as you can see, they range from a low 30% to about 50%. So I think our assumption of 40% is reasonable. And here we have the break-even prices compared to Renewable. So here you can see what would the projects need to make sufficient economics, given that they had the investments and they had the operating cost that we have assumed, which is a percent of the investment. How much would they need? And as you can see, the first project, the blue line here is what is the German subsidy price, and it falls dramatically after year 10. And here at the lower part is the Nord price, which I have estimated at about 40 cents per mega kilowatt. And that of course is a much lower level, that might be the Nord price might be reflected as a market price for the electricity. And the subsidy price, of course, was much higher. So the Hywind Tampen is the one that has the highest break-even price, and then the other projects that were coming from 2010 and getting lower. And the prices, since the break-even price is lower than the German subsidy price here for most of the projects, except the Bard offshore project, because the Bard offshore projects had huge cost overruns and had terrible economics. But the others basically was able to make money because they had a break-even price lower than the subsidy price. So here I have summarized it in the table, the economics. On the left side, I have shown the economics, given that they were facing the Nord price. And on the right side, I have shown the economics with the fixed price. And if we start with the fixed price and the nominal internal rate of return here and the net present value, you see that all of the project made a positive, of the German project, made a positive internal rate of return, except the Bard, which has a huge cost overrun. But the project from 2015 to 2018 were quite reasonable returns, where they have about 11–15% nominal rate of return, which is really high. And you can see why maybe the German subsidy price system was changed, because that is much too high return for a fixed price project. But if these projects had faced a Nord Pool market price, the net present values would have been terrible, and there would be no internal rate of return for these projects, because the return would not have been sufficient compared to the investments and the electricity produced. So the question remains: what will happen now in the future? As we have seen in England and in Germany, the new system where you bid for a fixed price has lowered the level of the fixed price considerably and made it more attractive made it more attractive in terms of the subsidy being much less than it was at this early time. But it's still quite a lot higher than you would say that the market price for electricity in a free market is, as the level of Nord Pool price indicates, which is about 0.4. And I would say now that the latest contracts might be able to bid down to 0.6 or something, but it's still quite a lot higher than the Nord Pool price. And I think the investments would have to become further down and be able to produce prices and there's also, of course, the question of, if you remove this fixed price, then of course, as we have shown, then the investors will require a higher rate of return, because they will be facing a market variable price, and then they will require maybe 8.5, and maybe it will even move up to what it is for petroleum projects, about 10%. So we will see what happens, but at the moment it's fixed price, and therefore they accept much lower return. And it still seems to be a lot of investments in the area. So with Petroleum will continue, but yeah, we'll see. So I think that was my presentation. I think it was short and to the point, but I'll take any questions if there are any.
Thank you very much, Magne. Is there anyone who wants to make a question? Maybe you can raise your hands or only turn on your microphone and ask a question. No questions? I will have a question then. Okay. Just about this graph, I didn't understand. You said that the German government
subsidy priced, yeah, the Stauschung model, yes. That's the blue line here, because that we have then it's like 10 years with this high price level, and then it drops to 3.9 cents.
And that was at what moment that the price dropped?
Well, it changes with the different the contracts. In our modeling, we'd use 10 years, but in the contract is like this. It's 8 years minimum for the offshore, or it can be 12 years. But for most of these projects, it's more likely that it's 12 years than 8 years, because they are enough from the shore, and they have a deep enough water level to be able to apply for the 12-year. Okay. So here I have assumed 10 years, not to be on average, to show a level of the economics.
Yes, we had that in Germany for quite some time, that also in onshore wind, that there was a step down at some point. This essentially was created to take away the major risk in the beginning of the major investment that was necessary for wind.
That is correct, because basically you have paid down all the investments during those 10 years.
Yeah, and this is known at the beginning, the new price? Or it has changed?
They were told the price, and they just had to deliver that power to the grid.
Okay.
And then they were, as long as they delivered the power to the grid, they were paid this price. So okay. All the risk was really on the consumers.
Yeah.
We have a question from Sahid in the discussion, so I read it. What is your view on the UK contract for difference in the Germany context?
I'm not that familiar with the contract of difference, but I have been looking at a couple of the English projects recently. We've been looking at the Dungeon project, and the other project was the Dungeon and well, anyway, we looked at those projects, and it's also a fixed price contract, but because they are bidding for the price. And I think what's happened is that the bidders has been lowering their price expectations, but they want still the fixed price, of course. But that has made the return of these projects lower quite a bit. I think I think there was about a 3-5 year difference between the commissioning of these two projects, and I think the return dropped by about 3%, from a nominal return of about 9% to a nominal return of about 6%. So there is a squeeze on the producers to lower their return to win the contracts. I don't know if that answered the question, but I think that's the best answer I have on that one.
I have a question. You mentioned that, I think you mentioned that in some cases the subsidies are stopped. Why do you think that the governments are maybe stopping the subsidy approach? And what do you think is the future for this type of subsidizing?
Yes, I think what we've seen is that they are moved away from they're still subsidizing, but they are not subsidizing at the high level, because now they're asking for the companies to come with a bid. So instead of giving them a price of 1.92 from the beginning and say everybody who wants can develop a project, and you get 1.9 per kilowatt you're delivering, Now they're saying, please give me an offer for a price that you can deliver the electricity for. So that has changed the level of subsidy to go down. So the consumers will not pay as much as they did, but it's still a form of subsidy because they are still giving fixed prices above what you would say the Nord Pool, the market price of electricity is, at least in Europe. And so, so if the Nord Pool price here is 0.4, they are now maybe pressuring it down to, let's say, instead of the 50, do you see, maybe they're down to about 60. So they're bidding to get the contracts. The lowest bidder gets. So that's what they've been trying to do. So it's still subsidy, but it's reduced. And it's really the government to say, we'll give you still a fixed price, but it must be much lower.
And does that change the beta of the renewables project, or
what?
Does that change the beta?
Well, yes, of course it does, because when you run like I said, the return requirement is much lower, and that's really the key here. As long as you give this producer a fixed price, they are willing to accept much lower return.
Mm.
So that's why I've used 6% on the fixed price contracts and not the 8.5.
Yeah.
Because 6% nominal return is a very low return, and it's more in line with the newest contract. But if they were facing a market risk on the price, they would not accept 6% anymore. They would need to accept, they need to be more like the oil business, almost 10%. And here I assumed 8.5.
Okay, I'm sorry, I don't remember. This 6% is higher or lower than the energy, oil and gas?
It's lower. It's much lower. 6%
lower.
nominal return is lower than the 10 and the 8.5 nominal.
Okay,
because so it's on a fixed price contract. It's on a fixed price contract.
So we are still we're still making things to reduce the investment on oil and gas related to renewables, even with the lower price.
For the oil and gas, generally, I would say that the investors require a minimum of 10% nominal return, because they are facing market prices and they are variable, and so the return requirements are much higher on when they don't have a fixed price to deal with. Yeah.
Okay, thank you.
This is the feed-in tariff system that we had in Germany for quite some time, and it essentially covers the different expectations of investors. The 6% is something we use to calculate for also PV systems, for example, simply because 6% used to be what you could get when you were investing in German funds, right? Like the state bonds. Right, so that was risk-free. So this is why the 6% was used to be calculated. Obviously, at the moment, I mean, these are at a completely different level, but nevertheless, this is still kind of used. And for larger projects that are more taken up by big companies rather than private people, for example, higher rates of return were used, like 10% or something, also by the government when calculating these fixed feed-in tariff system prices. Yes.
Magne, I have a short question. Do you think the NordLink interconnection project between Germany and Norway will have a significant impact on the profitability of oil and gas in Norway, if there's more German wind that is injected in the Nord Pool?
No, I don't think it will have any effect on the oil and gas profitability, no. But it might have some consequences for the long-term Norwegian electricity price. And of course, I think what's happening with the cables is that you will get a more of the same level of a price in the south of Norway as you have in Europe. Because they will just, you know, the flow of the electricity will go where the prices are highest.
Well, at the moment, what we could see from our calculations with our energy system models is that Norway is taking up quite some electricity, because in Germany at the moment we have, obviously, you know, the prices are changing quite a lot depending on the input of wind and the demand at the same time. And we have hours now where we have negative prices at the EEX exchange. So essentially what we see from our models is that Norway with its hydropower is taking up quite a lot of these negative price times, essentially to charge, so to say, charge the hydropower plants. Yeah.
Yes, but when the wind is not blowing in Germany and it's cold and you don't, then the flow is going the other way.
Yeah.
Thank you very much. Is there any other question?
Yeah, we have 3 minutes left for more questions if you want.
Okay, so maybe we can start with the other presentation. This is Marlene O'Sullivan, who is going to present us the paper, which title is The Relevance of National Markets for the Development of New Industries in the Energy Sector. She's at the Department of Energy Systems Analysis, the Institute of Engineering Thermodynamics at the German Aerospace Center. The floor is yours, Marlene. We can't hear you anymore.
Okay, I just had to find the button. Thank you very much. Yes, I'm very happy at these very early hours in Germany, very cold and yeah, not very summery like today, to present you my slides. Can you see them in the right way, or is it the presenter's kind of mode?
This is with the notes, maybe.
Okay, let's see.
Maybe you can try to go back and pull full screen.
All right.
Can you try just to go back to the previous screen?
Yeah. Now, wait. Ah, there you go. No, not this one. Right. Yeah. Better?
Oh, it's in Germany.
Can you see it now?
Yeah. Wait.
Can you see it now, or is it the right way around or not?
Yes.
Right,
now it's working. Perfect.
Now it's working. Okay, great. All right. Now that the technical difficulties are done, I am very happy to present you my work on, funny stuff, on the relevance of national markets and development of new industries in the energy sector. Well, the theory I want to apply to this subject is the one of industry life cycles. This theory had been developed in the late 90s by Klepper, and it essentially is derived from the concept of product life cycles. And most of you have probably heard of before. It describes 3 phases in a industry life cycle: the early exploratory phase, in which essentially a technology is developed, a growth phase in which the dominant design turns up, and then a phase of maturity where the market volume kind of stagnates and the number of companies is reduced due to consolidation and shakeouts of companies that are not as profitable. Also, we have in the literature mostly, they mostly look at national industry life cycles, as obviously this in the 90s or early 2000s, the globalization had not been quite as far as it is today. So mostly national industry life cycles have been explored so far in the literature. And also they look at industries that create demand for new goods and services. That sounds a bit funny at the moment. It's essentially means that, due to innovation, new demand is created for a new good, which is not the case in energy, as we all know, as electricity is still electricity and heat is heat. And what we're trying to do with the transformation situation now is to put one technology for another, meaning that the one technology that is new is not quite as advanced in its economic development as the incumbent technology, and therefore it's quite a different situation. Therefore, we have, as we just heard, also these various interactions or interventions of politics, and therefore the demand or the market volume of renewable energies here in green is essentially driven by state interventions and by policies. So therefore, the question for me, which I find to be quite interesting, is which market development has a larger relevance for the development of new industries in the energy sector, the national or the global market, simply because so far the aspect of what these various state interventions do to the industry that provides technology has not really been looked at so far. What I have done so far when tackling this subject is we've looked at the wind onshore industry and the global solar cell industry, and I will present you or give you the information that I found out or the findings that I have for these two industries so far. The global onshore wind industry development. Here you see, oh yeah, just quickly go back. I've got these two indicators that I'm looking at: the market volume and the number of companies. The innovation indicators I have neglected in my work so far. So now looking at the global onshore wind industry, you see these two, figures. They look completely different. You have the green, the green line with the installed capacity essentially, and you have the red one with the global, the number of companies that were observed in the time from 1980 to 2017, essentially. What I've used is I've taken the data for newly installed capacity from national and international sources, and the data on number of companies I've derived basically from a global wind farm database, which was not sufficient in the early beginnings. There I had better data that I then added from Denmark and the US, that I added to the data from this global wind farm database. Also, then when you look at the different cycles, so to say, you see that with the green, the newly installed capacities, it does seem like there's two cycles there. And when you look at the number of companies, it even seems like we've had 3 industry life cycles so far. And not understanding this, I figured, well, I have to look more deeper into the national developments, as the global development does not seem to provide the information that the theory that had been proven in the context with other industries has provided. So what I've done is I've analyzed altogether in detail 12 national developments. Here some information just for 4 of them. There's Denmark, Germany, the US, and China analyzed here. I will not go too much into detail with the data here with these pictures. It's way too much to present in these 20 minutes. This information has been already published in a paper last year. The data was analyzed by using descriptive statistical methods. And the findings of this paper, or of this work, was essentially the evolution, or that the evolution of global wind industry is characterized by a number of national industry developments. Meaning we essentially have national developments that are then added up to a global development. And regarding the political support systems, we found that it had quite a large influence on national industry life cycles. So essentially, for countries like Germany, which had for 30 years this feed-in tariff system that we just talked about, which was a very stable system and companies could rely on, and the market development was quite stable, we could see that the national development followed the industry life cycle model as described by Klepper. So it was essentially providing a similar market like a normal market under normal market conditions with a new product that creates new demand follows. With unstable national market developments, which we had in quite many countries, also in Denmark, for example, also the US with the stop and go developments, we observed a very early shakeout phase of national-based companies. That means, they essentially vanished very quickly from the market and left 1 to 2 companies at most. And also another finding was that the national industry development could be observed once, meaning once a shakeout phase had occurred, even when the market picked up in a country again at a different point in time, no real new companies did come into the market, simply because the existing companies were the incumbent companies at that point. They had their advantages and were essentially established in the market and didn't have as much high risk as new company developments. Therefore, no real new industry developed after the first shakeout phase. Also, the last thing that I found, which was quite good with the data that I have, it was possible to look at the competition on the international markets with the Herfindahl-Hirschman index, and I could show that a more competitive market can be found in countries with no national industry. And looking into more detail, you could see that in those countries that had a national industry, the development resulted in a dominant role of a few companies. So essentially national companies were very strong in their own home market. So that also obviously describes why then the national development or the national market development had such a strong influence on those companies. So the hypothesis that one would assume could be taken out of this is that national market developments have had a strong influence on industries in the renewable energy sector. But to look into whether this is actually true, I then took up the next industry, the next largest industry, which is the solar industry. And I focused on the solar cell industry, simply because there's otherwise too much going on, let's say, because you can see here, we're looking already at, I gathered data for, I think, 500, 600 companies altogether over quite some time. So the market data you can see at the same time is limited. There's only data available as of 1992. It's on newly installed capacity use from an IEA PVPS. It's the best data available. Unfortunately, there is no real data since 1973, when the first solar companies appeared on the screen. The data on the number of companies was derived from desktop research. Essentially, we used main sources like the publications from JRC, from Jäger-Waldau, and IEA PVPS. Also, a source was NF Solar, which is a web page that provides information on companies that are working in this field. And then from that I derived through the research of company websites when companies were created, if they are really working in the field of solar industries, and if they have been taken down at some point. So this information was all used. And the finding here, you can see, what you see here looks much more what you would expect from the theory of Klepper on the global development side, though. So the global development does seem to produce the original, to follow the original industry life cycle theory. But nevertheless, I took a look deeper into the national cell industry development again in order to gain more information of what has been actually happening there. I looked into 9 national developments simply because these countries were the ones that produced or that brought up most of the industry in this field. Statistical analysis was unfortunately limited due to the low availability on national market developments. For some countries, we could have the information just like for the global from PVPS. For other countries, they only have limited information on single years and so on and so forth. I mean, you can see even here in the US, we have information as of 2002 and no earlier. So therefore, the early stage of the market development could not be analyzed statistically. Nevertheless, there's quite some findings that can be drawn out of this as well. For once overall, the global development of companies, as I said before, that produces solar cells follows the original industry life cycle theory. And since 2011, the number of companies active on the market has been decreasing as the global market slows down. So essentially we're in this phase of maturity now as well here in the solar industry. Then we have statistical analysis that shows that the national market does not show the same explanatory value for the development of national market participants as the global market evolution. At the same time, there's one country where it's slightly different, which is Germany. Here we have the statistical analysis shows a slightly better result in explaining the growth phase of the industry with the German market development. But this, when you look into this, you also have to understand that for the first growth phase of the industry, of the German industry, the German market was up to 66% of the global market. So therefore, the German market dominated the global development very strongly at that time. So this has to be taken also with a notch then. And in China, at the moment, the statistical explanatory value of the national market is also almost equal to the global market development, which is also because China plays such an incredible, huge role in the global market at the moment. And then last but not least, even though the industry life cycle suggests that the global solar sector industry is in the phase of maturity, there are still new companies founded that pick up on the latest developments in cell technology. Yeah, so we still have, it's not like this is all set and we're happy with it, but there's still development going on and still companies are founded all over the world, even though more are dropping out at the moment than the other way around. So conclusions of further research, the hypothesis that national market developments have a strong influence on renewable energy industries does not hold true at all levels. The wind and solar cell industry have in common that the creation of national demand has been a driver for the creation of companies in a country. So this can definitely be said from what I found so far. In the case of wind turbine manufacturers, the domestic demand seems to play a decisive role in the survival of companies, whereas for solar cells manufacturers, the development of the global market is of a greater relevance. And then further research obviously needs to be made to understand why the role of national markets for these technologies differs so much. One reason, for example, could be that investor structures are different. Another one could be, which is also maybe similar to that, to the first one, that different distribution structures are in place, and also the transport conditions for these two technologies are also different. So this is it for now, and I'm happy to, yeah, I'm open for questions.
Sorry, I was in mute. Thank you very much, Marlene. Is there any question?
Yeah, I have a question. I'd like to know, why do you think that I didn't quite get it. Why did the national industry, or what reasons do you think the national industries failed especially during the shakeout phase?
Excuse me, I didn't quite understand your question.
You mentioned the shakeout phase, right? Mm-hmm. And there was a decline, especially among the national industries. So yes. What do you think was the real reason, or you personally feel was the reason why these companies especially didn't survive through that phase?
Yes, in wind industry, this was essentially because of the, let me try to go back, too many funny slides. It was essentially due to the, well, that market, they're essentially stabilized by the national markets, you know, their main, well, the main market is the national market, and exports are essentially used to stabilize fluctuations in the national market. But once the national market actually plummets down, then, you know, there was no holding it anymore. This is essentially what, yeah, the situation was there. I mean, you see here, for example, Denmark, right? In Denmark, you see at the moment, this is now a newly installed capacity here. This was the first wave, went down, then second wave, so much like up to 600 megawatts installed in a year, essentially went down to zero again. right? So we've had real bust and burn bust cycles, and companies can do that for 1 and 2 years. But if you don't know what's actually going to happen, and there you can actually very strongly compare that to what's been happening with governments. It's each time a government change was, they essentially stopped all support of wind energy, and the other way around. So it was real boom and bust cycles, much more than in the US. But even also in the US, you can see here, which is here, this little one was actually first huge global market in the 90s, you know, done in California. Right, and that in that time, a huge amount of companies were created, right? And here the green or red line are US companies, you can see, and the blue one are companies that were active in the market here, yeah, which were a lot of the Danish companies that had already been created. And essentially, with the market going down here as well to essentially nothing again, they all vanished. Yeah. So essentially in the US, we have essentially one company that was left, which is GE. Well, they bought the companies that were before. And in Denmark, we have Vestas left. And obviously Siemens Gamesa bought another Danish company, and they're still producing there. It's Bonus, form Bonus. Yeah, but essentially it boils down to each country having 1 to 2 major players left, and everybody else has vanished. And this is what's happening in Germany right now. We've said that our feed-in tariff system has changed, right, from our fixed remuneration for essentially 30 years to now a bidding system, which has also led to quite some difficulties in Germany. The market has been plummeting down, and the number of companies has also gone down quite a bit. Yeah.
So I guess your results can be linked a lot to whether the companies face a fixed price that's given by the government, or if they have to bid for a contract where they are facing a totally different competition.
Well, not necessarily. It's more, I mean, these companies they don't have to make the rates of return, right? They're not the ones that are running the wind turbines, but they are the ones who are selling them. So essentially, it just shows if there's a stable market development or not. I mean, it can be market development.
But they cannot sell it to anybody if there is not enough companies who face fixed price. So that's just a level down. That's the
essentially,
suppliers.
Yes. Yeah, but
so
essentially, let's say
definitely should affect them.
Well, it doesn't need to be. I think the takeaway is it doesn't need to be necessarily something where companies get a lot of rate of return and huge market develops. So what's important is that whichever market develops, it's a stable development, which is not up and down from one year to another like crazy, because no company survives that.
Do you know of a country, an area where there has been a huge increase in wind and solar energy without a fixed price?
Not in the beginning, no, obviously not. No.
So no. Not even now.
No, absolutely.
No,
but
they need to face a fixed price.
Yes. But this is obviously due to the fact that they have to face, like coal power plants and so on and so forth, that have had a different situation or were around a lot longer and are at a different development level as technology. I mean, at the moment, prices have gone down so far for these technologies that they're now starting to enter, to be competitive, essentially, to other energy technologies.
But when I looked at the German the projects offshore, at least, I don't know that much about land. I think maybe the costs are coming further down there, but it seems to be a long way before they can face a Nord price. Even the latest projects need to reduce capex by 50%. They're not even close.
Well, yeah. That's possible. I'm not sure there. I don't have the exact numbers. I mean, obviously, it also depends on which
I'm referring
times.
to the numbers that I did,
right.
It's still so far. It's still, even the English project that we looked at, even when if they should face a market price given the Nord Pool level, they need to reduce cost at least by 30-40%.
Right.
Thank you. Are
We
there
wait.
other
Also,
questions?
yeah, we have plenty of time still, so do not hesitate.
I don't have a question, but I will have a suggestion. It will be possible in those graphs that we are looking to indicate the regulatory changes in order to see if they are right in the good place.
Yes, well, unfortunately, I didn't bring that one. I have a slide that has shown these exact changes in the regulatory, changes. It's essentially the market development follows these changes. Unfortunately, I don't have the slide with me at the moment. So, but yeah, it's right there. Essentially, so each time these ones and this one is for here, Denmark, for the US, for Germany, and China are the market developments. Here in Germany, I said we had the feed-in tariff system. Nevertheless, we had a kind of a dip here, which is because the feed-in tariff system was adjusted. So they got a lot lower price at that point. And here the bump up in Germany, what happened here was not that the tariff system in Germany actually changed so much, but what happened here, it's very interesting. This is the development of Spain. So Spanish government stopped subsidies for, or feed-in tariff system for wind energy in Spain, and essentially, yeah, developers of wind projects looked for a different place where they could, get to, essentially. So yeah. This is what happened here. And also it was another thing is that before everybody knew that at that point in 2017, 2018, the feed-in tariff system as it was would stop. So all projects that were maybe in line for a longer period of time were then brought forward as quick as possible. And what we have at the moment in Germany, we have quite a reduction down to 1,500. So this kind of level of newly installed capacity in a year in 2019 now, or 20.
Mm-hmm.
And again, loss of a few companies, or one big company again. It's not that many left.
Okay. Have you thought to do an event study analysis?
A what?
An event study, you know, when you have a series and you have events, and then you can calculate statistically if those events are significant or not.
No, I've not done that. The problem with these, I'll have to look into that. Thank you for the suggestion.
Yeah, I said that because you have those methodology used to asset in the asset analysis, and I have done once something like that with the European carbon market, when you have the carbon price and you have the European Commission that has announced things relating to the carbon market development, and we develop a methodology to see if those announcements were had an impact on the evolution of those prices. So maybe you could do something related to that with those series and your regulatory changes.
No, I must confess I have not focused on that. I essentially refer to literature there, because there's been a vast body of literature that looked into the effect of these regulatory regimes on market developments. So I essentially just kind of based on that, because my focus was more on getting the data for the industry development, which has not existed before.
I can send you some by
that would be nice. Thank you very much.
Yeah. Okay. Are there any other questions? No. So maybe we can, thank you very much, Marlene.
Thank you.
Maybe we can follow on the next presentation, who is done by Sandra Obiora. The paper is entitled Maximizing the Business Opportunities in the Renewable Energy Industry. And Sandra is at the University of Electronic Science and Technology of China. And okay, everything is ready. So Sandra, you have the floor.
Yeah, thank you. Can you see my
Yeah,
PPT? Is it okay? Okay. Can you hear me clearly?
yes.
Yes.
Okay, awesome. Yeah, thank you. I've enjoyed the last two presentations, actually. It's quite an interesting session. So I'm taking a bit of a more management approach in my topic rather than a purely empirical. Those are in different papers, other papers. And so, yeah, I'm also I'm calling in from China. So I'm in Chengdu, China. I'm a PhD candidate at the University of Electronic Science and Technology of China. My presentation content is just simple. The introduction, I'll talk about the rising demand and supply for RE, or renewable energy, a bit about the renewable energy industry leaders, which some of us have already mentioned. I saw in the previous two presentations. I'm going to be talking about the USPs, so the unique selling points and the competitive strategies that they're using, and then a few recommendations and conclusions. So actually, this issue of global energy transition has become quite a big deal in the last, let's say, 2 decades, you know. And because of this, I would say the relevance of the energy industry, especially in terms of renewable energy, has risen. Not just, you know, in the sight of governments, for example, who are very concerned with that, but just the average person has become very concerned, you know, about climate change and things like this. And so the energy transition towards low carbon emissions for many countries has remained a long-term strategy. So even now, I'm doing most of my research is on energy economics, or most of my publications is on energy economics. And when comparing developing, developed, and emerging economies, you'd find that developing economies who previously were not so concerned with it are now becoming more concerned with that. So there is this middle ground where every economy is trying to reach between achieving economic development, but not at the expense of the environment. So it's a thin line. And so, well, despite this pronounced necessity, right, the global energy transition is still very, very low, if we're being honest. And also, although there's like political interest, right, there's still quite some hesitancy, right? So there's this awareness that has increased among people, just the average person. And then we still have this, you know, it's kind of like a, kind of like an old blanket, you know, that you're used to, which is fossil fuel powered energy, and, you know, all through your house, your car, everything. And there's still hesitancy generally, and there's a research that found that especially among democratic countries, there still is kind of this hesitancy to switch towards renewable energy. And many private firms in the energy sector have taken it upon themselves really to uphold this vision, you know, and it has become their primary reason for existence, and to attract you know, customers, to attract people into this market to partake in it. So an increase of renewables are decreasing the viability of energy business models, and the rise in popularity of RE. With the rise, there's also an increase in the competing firms that are supplying. So the last speaker mentioned that, you know, I really liked the graph about the, you know, the life cycle of the industry. And it has become more interesting now, especially from the management perspective, to observe the RE, the top players in the RE industry, which is what I'm really doing today and in this paper. So the policymakers must now examine the future business model viability. So it's no longer enough to just exist as a renewable energy company that is needed by the world about climate change. We understand that it's a big deal, but when we talk about it from the management perspective, what do you have to show for it? How can you attract customers? It has become pretty much like any other secular business out there. And so just like in the last speaker's paper, you know, there is this shakeout phase, and there is the growth phase, there's the fierce competition at the maturity phase. So more and more companies, and then we find that a lot of them drop out because it's just kind of not what they expected. And so most discussions have centered, of course, on the policy transitions from the importance of global energy transition, but few have really considered the business models being utilized by these large players, you know, like, so I'm going to mention a few of them. So in the actual paper, we have 10 case studies, right? We take careful look at each of these top players in the world. But today I'm going to just mention about 5 of them because of our time constraint. Now, so world electricity production from fall, right? It is continuously going down, right? When we're looking from 1971 down to 2015, we see that actually the fossil fuel electricity production, for example, has a downward trend. We find that world renewable energy electricity production rate has, on the other hand, so it's like the opposite, it's gradually been going up since around like 1994. And world renewable energy electricity output, right, has continued to increase as well. And then the consumption of renewable energy, you know, it has had like its fluctuations, like we've seen before in prior presentations, but generally we're starting to see an upward trend again. And world energy use altogether, you know, whether it's fossil fuel or renewable energy, the need for energy just continues to rise. It's like has no end, you know. So whatever kind of energy can be supplied, it seems to be needed either way. And so I'm going to talk about 5 of them, and the first case here we're going to discuss. So I'm talking about 3 things for each of these. So first, just a bit about them, then their USP, right? And then their competitive strategy. You know, I try to look what is keeping these, what has been sustaining these companies, especially with the, you know, up and down of, or should we say the temperament of policymakers and subsidies coming and going and all these types of situations. What has kept them going from a business or a management perspective? Now, First Solar is, as of the 3rd quarter of 2019, when I put the paper together, it was holding the crown for being the largest photovoltaic solar panel manufacturer in the US, right? And we're talking, as of the 3rd quarter, about $30.6 million in net income, and revenues going up to $547 million, right? So as of 2019. So we're talking about a very highly valuable company, whether it's renewable energy or otherwise. And so I checked, I would wonder what would be their unique selling point? What is their value proposition really that's keeping them so relevant? And so one main thing they do is to break the clear-cut boundaries that have been set in the RE sphere. Very first to be there, also they're the very first to be able to generate power at below $1 per watt, right? So what, if we look at it just from a standard business management perspective, we're talking here about price penetration, for example, you know, trying their best to cut the cost and presenting something that seems really affordable to the consumer. And of course, beating out competition at the same time, because they understand that when we talk about, it's just kind of like eating very healthy vegetables, you know. It would just be maybe 3 carrots and it could be like $5, or in Chinese yuan, let's say like 20 yuan, right? And then just normal carrots that are grown just however by the roadside, you know, would be like $5. So we have this impression that when we try to change our lifestyle to be greener and better, it's going to be more expensive. But First Solar here, they're trying to break this impression, which is a good thing. And they boast of the ability to significantly deliver much more usable energy per nameplate watt compared to other suppliers. And they boast having the smallest carbon footprints, the lowest life cycle water use, and the fastest energy payback in the RE industry. So these are the claims that they make, and they have figures to back this up. And so they present themselves not just as, you know, some kind of energy transition savior of sorts, but, you know, they're like, look at, we ourselves as a company, we already are making sure that we have a low carbon footprint, things like this. Now let's look at the First Solar's competitive strategy. So between 2007 and 2011, they started to expand, right? So they took up the initiative to expand their manufacturing plants to Vietnam and to Malaysia. So this was also part of the reasons why they could, you know, manage to cut costs a bit. And during the recession, right, they took up a short-term strategy, which is to cut back on those initial plans. And then they recognized that their over-dependence on the European market subsidies, right, was not a sustainable approach at all. So their goal was to find any way, right, any way that they can just reduce the impact of policy fluctuations on their sales and their revenues. So they came back into themselves, like, okay, what can we do as a company, just like any other company, to really attract consumers and really stay strong? And these are some of the ideas that they started to realize that they can no longer rely on these subsidies and the ups and downs. And so First Solar placed emphasis on maintaining sustainability through innovation, right? They realized innovation is so important, and using vertical integration as a means of realizing opportunities and strengthening their capabilities. So this was just a few of them. There's a lot more to each of these cases, but I'll move on. Now, Canadian Solar, right, is among the top 3 largest solar companies in the world. And they've shipped over 38 gigawatts of photovoltaic modules over an 18-year-long history. So they've been around for a while too, right? And we're talking about 3.74 billion in revenues. So this is also a very high valued company. Now, their unique selling point is also, it's a bit different, right? I thought it was really interesting. So they market themselves as being able to provide high value, right, per product. Now we see a bit of a difference from First Solar, who try to cut costs, right, and present an affordable product for the consumers. But they are producing, rather, they're offering high value, right? We would see in their competitive strategy, they put more importance on quality management, right? So they, Canadian Solar also focuses on using high level technology for manufacturing their products. And so they're constantly improving the quality to make sure it's not really comparable. You know, when you go into it, no matter how much you pay, you can be sure you get back your return. And so its overall trend of profitability is indeed a selling point to the potential investors. So Canadian Solar is not just looking at the consumers, but they're looking to offer value to their, a lot of value to their, to the investors as well, to their stakeholders, all the stakeholders. And they boast also ownership of a lot of patents. Now, looking at the Canadian Solar's competitive strategy, right? Like I mentioned, top quality products and services. This is like a company culture for them, right? Even if it's gonna be expensive, it must be the best quality in the market, like possibly. And they also, their main competitive strategy is derived in strategic positioning in the downstream market. And its offering of specialty modules, such as, for example, there's an Huang series that they released, and it delivers even higher performance and cell efficiency, which is almost not replicable by other RE industries. So once again, we're talking about investment in high technology for manufacturing their product. And so their emphasis is on excellent human resource management. And, you know, they have this culture of, like, you know, welcoming all people and this type of stuff that people just really like to see in businesses. So CSR is also a really strong thing for them. I might only talk about one more. How much time do I have left? I think I didn't follow the time properly. How much time do I have left? Okay. Okay.
Sorry, I had the microphone. You have 10 minutes left.
Oh, 10 minutes? Okay, awesome. Okay, so let me not jump too far. Okay, let's talk about Vestas now. So Vestas is headquartered in Denmark. I know the first speaker mentioned, or I saw Vestas and some of these companies in his first list on his slide. And so they're more focused on wind turbines, right? And they have the largest market share in the field of wind-based energy specifically. And now this is also something that puts them apart from the first two cases I mentioned, right? So their drive is to increase their installed base. Now, as a management student, we learn about the importance of installed base, but we usually talk about it more like in, for example, if you have a Windows versus you use a Mac, right? Before, maybe now it's a bit easier, but before you need, if you use an Android, or let's say if you use a Mac, you need to follow the Mac route of doing everything else, right? And so, for example, that's why Windows was a winner, or it still kind of is, right? Or it's Windows you'd normally find, maybe not so much now, but still a large percentage. You usually find Windows computers in companies and things like that, because this is an installed base. It's easier to do everything else, right? Than to put, for example, a Mac computer and you need another whole other Mac thing to just do basic stuff. And so Vestas' strategy, right, is to increase their installed base. So it's not, you can't use anything else but theirs, right? And so they boast as much as 18% of the globe's installed base. Over 90 of the total combined capacity under service, right, belongs to Vestas, which is quite incredible. Also, they have a lot of patents worldwide, right? So their competitive strategy, their main competitive strategy is in their service offerings. So they're not talking first, of course, they're going to have the quality, of course, they're going to have just, you know, a reasonable price, but they're not focused on that because they realize that's not their strong point. But their service offerings is their strong point. So they offer a competitive range of flexible maintenance offerings, right? If I buy something, I really would prefer, if there are two options of buying, for example, a refrigerator, I would prefer the one that has maybe a longer warranty and guarantee and all that stuff. So they're that kind of company. They're like, we have your back, okay? We've got you. Whatever may fail, whatever happens, you know, we will fix it for you. We will come by, things like that. And so they boast having over 43,000 turbines in service and over 8,000 service technicians, right? Scattered across 67 different countries. So they're always nearby to fix any issues, to answer any questions, that kind of company. And so the firm's age, right, it's also quite old. Service offerings and other like the USPs and customer loyalty, right? Customer loyalty. A lot of us in management, we know that when you buy a product, I mean, if you own a company, usually most of the revenues in the long term comes from repeat customers, not from one-time customers, right? And so Vestas realized that this is something really key, right? And so they try to keep their customers and increase their customers' trust and loyalty in them. Now, I'm going to just talk about Tesla.
You have 2 minutes left,
oh, okay,
Sandra.
okay. Okay, I'm going to summarize the Tesla case. The Tesla is now kind of more of a present day company, very modern type of marketing approach, right? They put a lot of investment in aggressive marketing. Like if you're gonna, it's those type of companies that you'd see their advert probably 10 times in one day without realizing it. So I can't talk too much about that, but it's something really interesting. And even their PR, especially in the person of CEO Elon Musk, is something that really drives sales for them too. And so in the end, I would say that from this research, from the case studies, several strategies come to mind. It's no longer enough for the renewable energy, industries or those in the market to just assume that they would be, because they're relevant, they're going to succeed. It's no longer the case. They need to really tap into real-time approaches in different companies to really be successful. So yeah, so that was basically it. It's really an interesting topic, and you can always look through my paper later if you want to. Thank you so much. I welcome any questions.
Thank you very much. Are there any questions?
Yes. I have one question, Sandra. So thank you for your presentation. So you ended by saying that they need to take into account a real-time approach. So would you like to comment on that, maybe?
Oh, yeah. You know, the like mentioned, for example, there's lots of fluctuations. Like from the graph from the last speaker, we can see like their sales and their revenues rise and drop based on subsidy changes and all these types of policy things. And so they need to overcome that dependence. Like as soon as any company that has managed to overcome that, they've managed to stay strong. So these are the companies that we're seeing right now, you know, like even Siemens Gamesa, they're two different companies and they merged, right? They have this synergic effect that they've put together all their technology, everything to survive together. So it's something really powerful. So there are many business approaches that they can look into from just normal businesses, a normal business selling cement or something, right? Trying to survive out there. They need to get this mindset now that if they want to move forward.
Yes, I do have a question regarding First Solar. My impression was that First Solar is one of the, let's say, Western PV companies survived because my impression was they bought up quite, well, let's say the solar thermal industry went down at the same time. And they essentially acquired large field projects that were in development in the US, and they turned them from solar thermal into PV. So essentially that was my impression, that they started to become their best own customer. So they have essentially created a demand for their modules by themselves, by just setting up projects themselves. So I think that for me was the impression is how they survived this let's say downturn of the global Western PV industry. Is that correct, or was there other
yeah,
factors?
You're probably right, actually. For what I realized that most of these companies, right, looking through up to 20 different case studies, they just went radical, you know, they really did everything they could to survive. I think some companies might think that, so for example, if we even take Tesla, for instance, it wasn't always easy for them. So now they've like taken over the electric car market, but it wasn't like they just suddenly did that. They had aggressive approaches, lots of money put into research and development and marketing and things like that. Even at the, you know, even if they would lose, they had this vision. So radical approaches need to be put in place now, not just normal like basic approaches. So just like what you mentioned, I think it's a really smart business approach, right? That's not really hurting anyone. So yeah.
Yeah, thank you.
Thank you. Other questions? Okay. So we start.
I actually have one more question, if I may. It is, have you also looked into Chinese companies? Because I'm very much interested how their approach was, or how they tried to do the unique selling point. From our perspective, we always kind of have the impression that they just go massive, like mass production, and that's how they get it. But is that the only way, or do they have other?
I'm in China, and going large is always the best approach. Everything, just they have this advantage. One thing also is that the Chinese market is highly government regulated, everything. So we can't always put it on the same plate as the Western market. The government controls everything. And so being on the good side of the government makes sure that you would succeed no matter what inside China. So take, for example, Alibaba. There are two kinds. There's Alibaba inside China, which is just for the Chinese market, which is called Taobao. And then there's the Alibaba outside. They're like two different companies, but they belong to the same company, right? The regulations, everything is totally different. So I would say the Chinese case, we cannot make any broad statements without mentioning the government, right? Yeah, so if the government chooses you, it's just like the stock market. The Chinese stock market is also quite different. If the government is on your side, you're gonna succeed on a large scale, like larger than you can imagine. Yeah.
But that also means that they are highly dependent on the national market in the end. All of them.
Yeah.
Okay.
Yeah, most of them would be actually, most of them. Those of them that succeed, you'd find that they go outside of China.
Okay, thank you.
Yeah, thank you.
Thank you very much. So if there are no more questions, we can start with the last presentation, which will be done by Nandeeta Neerunjun, and which title is Managing Intermittency in the Electricity Market. She comes from the Aix-Marseille School of Economics. The floor is yours.
I'm sorry, I didn't put on my mic, so I will start again.
Thank you.
Okay. Thank you. So it's morning here, so good morning, everyone. So I'm Nandeeta Neerunjun from Aix-Marseille School of Economics, and today I'm going to present my paper, which is titled Managing Intermittency in the Electricity Market. And broadly speaking, this paper is in fact related to the integration of intermittent energies such as wind and solar into the electricity mix. So my presentation will take a standard outline. So I will first introduce the subject, then I will take you through the main assumptions and some of the results, and finally I shall conclude. Okay. So to begin, it is now widely accepted that in order to reduce greenhouse gas emissions in the context of climate change, we need to shift to renewable energy sources. However, the adoption of such renewables as wind and solar is not that easy because of their variable and uncertain nature, which is collectively known as intermittent. So electricity produced from such renewables is intermittent and also inflexible because we cannot control the renewable resource in order to control electricity production. So what happens is that renewables intermittency challenges the supply matching demand exercise of the electricity industry. And this is a balance which is very crucial to maintain in order to avoid any technical and economical impacts. And in this context, what is recommended is to introduce more flexibility on the electricity market, which can be on the supply side as well as on the demand side. And in this paper, we focus on demand side flexibility. Now, looking back to the literature on demand flexibility, we found that its importance was first highlighted with the question of how to reach optimal capacities when demand is intermittent. Why? Because the business as usual is to satisfy any level of consumers' demand by investing in peak and costly capacities, which are sometimes used only a few hours a day. And all that in a context where wholesale prices changes with electricity provision and retail tariff which barely change. So we have papers such as Borenstein and Holland together with Driscoll and Tyrol who suggest the implementation of time-varying retail tariffs in order to make consumers more responsive to changing wholesale market conditions and therefore which can help in achieving optimal capacities. So with this, the question that we ask ourselves is, can retail contracts be designed to unlock demand flexibility now in a context where supply is intermittent due to the integration of intermittent renewable technologies? Now, a question that has been partly answered by, for example, Ambeck and Kram, together with Rouillon, who in fact study a model comprising of flexible and intermittent technologies. And what they find is that the first best electricity mix can be reached when consumers move from flat rate tariff to real-time pricing. And we can observe from these studies that they stick to two polar retail tariffs. And with this, we ask ourselves, can we take into account more diversified contracts in order to help the integration of intermittent renewables? So to answer to this question, what we do in this paper is to provide a theoretical framework for the integration of intermittent renewable technologies into a mix which comprises of conventional energy technologies. Now we propose that demand-side flexibility can be implemented through retailers who can offer diversified electricity delivery contracts at different prices. And the diversity of these contracts can be depicted through what we call in our paper the base state contingent electricity delivery contracts. So what we find in this paper, this is an overview of the results, is that our model is consistent with a partial equilibrium model. And the welfare analysis shows that it is constraint efficient. And what we are able to do finally is to characterize the condition when we change those base contracts, we are able to improve welfare, the integration of renewable capacities, as well as both of them. So with this, I will move to the main assumptions of this model, starting with the general features. So I describe intermittency by the set of states of nature S. And because of intermittency, electricity production is state dependent, and the wholesale market being organized in each state of nature. So I have state dependent wholesale market, which I assume to be perfectly competitive with state dependent prices, and I express expected prices by the vector P. Now, the second feature is about decision making. So ex ante of the realization of the states of nature, the investment in the renewable capacity and the conventional production plan are decided. And ex ante retailers and consumers exchange retail contracts for exposed electricity delivery. I will now get to the electricity retailing part, which is the most interesting part of my model. And retailers here are intermediaries between the consumption side and the wholesale market. So retailers here propose diversified delivery contracts, which are built as from base state contingent delivery contracts, which I will call base contracts for short. So to illustrate my idea, I will go through an example. So let's take a time of use retail contract with an off-peak period during the night and a peak period during the day. What I propose is to represent this contract by two base contracts, K1, which has an electricity delivery A1 in state 1 at some price Q1, and base contract K2, which has an electricity delivery A2 in state 2 at some price Q2. Now, if the retailer proposes these contracts, what the consumer will do will buy some quantity, let's say theta 1 of K1 and theta 2 of K2, so as to get his desired electricity consumption in each state of nature, depending on his flexibility, which is equivalent to the time of use retail contract. Now, the retailer can also propose a flat delivery contract, which is equivalent to the flat tariff. How? By a linear combination of K1 and K2, which gives, for example, the contract K3, which has the same electricity delivery in each state of nature at some price Q3, now offering less flexibility to the consumer. So what will I do now is to generalize this idea. So what I propose is that the random electricity of one unit delivery contract, K, be denoted by AK, and I have K such contracts which are traded on K competitive markets. Now the electricity delivery of the K contracts can be summarized by the S by K matrix A. This is the contract structure to retain. And the portfolio of contracts offered is theta R, so that the random electricity flow induced by this portfolio is defined by A theta R. Now, I assume that there are less contracts than states of nature, which can be explained by the fact that consumers may not be responsive to every change on the wholesale markets, but are more responsive to smoother changes. Also, there are no redundant contracts, meaning that no contract that can be made by a portfolio of the others. And there always exists an asset which delivers electricity in a state of nature. So with this, I can write the objective program, which is to make the optimal portfolio choice, which maximizes profit of retailers. And here I assume that retailers bear no other cost than the procurement of electricity on the wholesale market. I now move to electricity production to describe the intermittent technology. So remember, this technology is not flexible. So there is an ex-ante capacity choice that is made and is given by kappa. The state contingent production per unit capacity is described by the vector G. And the cost of investing in capacity kappa is given by the increasing and convex function K with usual assumptions. And I assume that short-run marginal costs are 0 because the resource is free. So the objective program here is to choose the optimal capacity in order to maximize profits. Now, the other technology is the conventional technology, fully flexible and existing one. It has a state-dependent electricity production, which is given by Y. And because it is flexible, I assume that its expected cost is additively separable state by state and is given by the increasing and convex function CS. The objective here is to choose the optimal production plan in order to maximize profits. We now move to the consumption side, which is described by consumers who have a random electricity consumption given by X and defined by a budget M node. And the money that is spent on other goods is given by M. Now, the utility function on the random electricity consumption only is given by the function U, which is increasing and strictly concave. And the portfolio of contracts demanded by consumers is theta C, so that the random electricity flow induced by this portfolio demand is A theta C, which gives X the random electricity consumption. The objective here is to choose the optimal portfolio and the optimal amount of money to spend on other goods in order to maximize the utility, the satisfaction of the consumer from electricity consumption and under a budget constraint. Now, with this, I can define a partial equilibrium, which is given by these optimal prices and quantities, which are solution, in fact, to the utility maximization problem of the consumers and to the profit maximization problems of the retailers and producers, and whereby the K contract markets and the S state contingent electricity markets, which are the wholesale markets, clear. Now, does such a solution exist? For this, we will get to the results. So when we analyze the partial equilibrium, we find from the no arbitrage condition, which is a condition which ensures that there is no violation of market clearing, that Q, the price of contracts, is equal to the transpose of A multiplied by the prices of electricity on the wholesale market. So we have a relationship between contract prices and wholesale prices, with prices being strictly positive. Now, when we solve the objective programs of the consumers and the retailers, we found that the demand for contracts results in a demand for electricity, which is denoted by the function D here. And this function is a differentiable function with a property that its derivative is a symmetric and negative definite semi-definite matrix, and we can also define the boundary conditions. To summarize, this function is monotonically decreasing, okay? Now, when we solve the objective programs of the producers, we found that the supply function is a differentiable function with a property that its derivative is positively definite, and we can also define the boundary conditions. So this function is monotonically increasing. So with these properties of the functions and applying the homotopy method, I found that there exists a unique price P, which clears the S different state contingent electricity market, and a unique contract price Q, which is free of arbitrage and clears the K different contract markets. So to summarize, I found that the partial equilibrium exists and it is unique. I now move to another result, which is the welfare analysis, where I want to show you that the contract structure matters when we make the assumption that there are less contracts than states of nature. Why? Because the potential contingent electricity consumptions is now restricted to the linear subspace that are generated by the columns of the contract structure A. Now remember that X, the random consumption, is equal to A, the contract structure, which is multiplied by the portfolio demand. If you have two contract structures, A and A tilde, with a property that the span of A is equal to the span of A tilde, then we can say that the two contracts are equivalent in terms of electricity demand. Why? Because depending on A and A tilde, what the consumer will do, he will only change his portfolio here in order to get his desired electricity consumption X here. So with this equivalence relationship, we can in fact write the contract structure A is equal to BCC, with C being an invertible matrix of dimension K. Now, if we put C is equal to the identity matrix with dimension K, knowing that X is equal to A theta, then we can rewrite this constraint as being I minus Bx is equal to 0. And here we can clearly see that for any change in this matrix B, the equivalent contract structure, there must be some changes in the random electricity consumption here so that this constraint is maintained. Okay. So with this, we can write the social welfare with the equivalent matrix B, which is to choose the production plan and the consumption allocation, which maximizes social benefit. Social benefit being the expected utility, net of the expected cost of the conventional production, net of the cost of investment in the renewable capacity, such that consumption allocation matches a production plan and the consumption allocation is constrained here. Now, when we solve this problem, we find that the first order conditions is given by these three equations. And if we associate lambda to prices P and mu to the constraint on trades due to the contract structure, we found that these first order conditions are similar to the first order conditions on equilibrium on the competitive market. So what I can say is that the competitive electricity production plan and allocation is in fact constraint efficient. Now I move to the third bunch of results, the comparative statistics, where I want to know how I can improve welfare. Well, there are several ways, but one of the ways is that as long as mu is not equal to 0, meaning that the constraint on trades due to the contract structure A are not ineffective, then any addition of a new contract A, which is linearly independent of the existing one, is welfare improving. Why? Because the consumption profile X are still reachable with this new contract structure when we add another contract, okay? Now, can I improve integration of renewable capacity? Well, mathematically, what it says is that if at least two components of this matrix are different from 0 and K lies between 1 and S minus 1, simply this condition means that if there are at least two constraints on trade due to the contract structure which are effective, then all the direction of price changes which improve investment in renewables can in fact be reached, especially the one which is collinear to G. Remember, G is in fact the state contingent production per unit capacity of the renewable technology. And this one maximizes the penetration of renewables. Now, if this condition is not fulfilled, then we must only ensure that any price changes, in fact, is not orthogonal to G. Now, can we both improve welfare and investment in renewable capacity? The answer is yes, as long as the change of the equivalent matrix B on the capacity and the change on social welfare are not collinear with a negative effect, meaning that they cancel each other. So with this, I will move to my conclusion. So what I've been able to do is to propose a theoretical framework that takes into account intermittency of renewables as well as demand side flexibility through diversified retail contracts, and thereby contributing to this new literature. Also, I have been able to show existence and uniqueness of my electricity market. And I have shown that when we make the assumption that there are less contracts than states of nature, which means less flexibility of the provider to the consumer, then the welfare is constrained. And I have also given you some of the conditions under which we can improve welfare and renewable capacity investment, as well as both of them. And what I can say is that in a general context, the results of this paper provide insights of how to redefine the role of retailers in a context of liberalized markets so as they can actively participate in demand-side flexibility. And this paper also highlights the importance of taking account intermittency of renewables in order to be really able to achieve renewable capacity objectives. So with this, I have finished with my presentation. So I thank you for your attention and welcome any question.
Thank you very much. So we have still 4 minutes. There are any questions?
I know this was a 360-degree different of what we have seen today, but it was a purely theoretical model, but I hope to get feedback from you, seniors.
I actually do have a question. I'm not sure if I understood you correctly, but I understood that your model shows that the demand for electricity function is actually decreasing depending on price, right?
Yes, it's the usual, demand function,
Right.
where demand for when price increases, well, we have demand which decreases. But
Right.
what I need to do is to write my demand function for the S states of nature, so which is different for a plan, let's say. So it's a square type of equation which I need to solve. So yes, this is.
I just have in the back of my head that
yes.
Various studies on the elasticity of electricity demand is essentially that electricity demand is very inelastic.
Yeah.
So that the demand, no matter how prices develop, essentially kind of stays the same. It's kind of my back of the head assumption that I have have had for quite some time, and I was wondering if this has changed.
Well, what I was wondering, in fact, what I'm proposing in this paper is like, if we expose consumers to prices that change on the wholesale market, which are very volatile prices, then this can like trigger a demand side flexibility because they are aware that prices go up and maybe that they won't use their washing machine at that time, and prices go down, then they will do all their house chores. So the demand for was inelastic for electricity because we had flat tariffs. So when we have time varying tariff, my suggestion is that we can adapt, in fact, the consumption to the supply side, which is intermittent because of the integration of renewables. So the intuition is that. So demand now is kind of adaptable to changes on the wholesale market.
Okay, but for that, the two markets need to be actually brought together.
Yeah. Yeah, and retailers here are kind of intermediaries between them, and they kind of send information of what is happening on the wholesale market to the consumer. Knowing that, I've made the assumption that we cannot send every wholesale market changes to the consumer because he will just go mad. So I mean, to say in layman words, but it's just to provide the intuition that if we can smooth those changes on the wholesale market and send them some kind of information, then they can become price responsive. And we have seen that contracts, you know, such as time of use or critical pricing, they have proved to be quite good in the sense, but it was used in a different context where demand was intermittent. So it was matching demand with supply. So I'm trying to see if these same contracts can now act, you know, because we have stabilized demand, let's say now to play the game in another way, you know, to go back and see if we can match now demand to the intermittent supply.
Thank you very
Thank
much.
you. We have a question from Sahid in the chat. I'll read it. Do you consider the role of peer-to-peer trading in the model?
Peer-to-peer trading with regards to what? To the retailers? Because here I assume that the retailers are like competitive retailers, so there are no strategic plans between them. So
I don't know, Sahid, can you just make your question more precise, if you don't mind?
okay, but if that was the question, if there are trading between retailers, where in my model it's a peer like a representative agent, so I assume that there is no strategic plan between retailers, so they are purely competitive. Right. So no, I don't take into account this.
I have a technical question, if you don't mind.
Yes.
So you have a set of different scenarios, and you assume that your conventional generators are perfectly flexible, which means that whatever the patterns and the next scenario, they can perfectly change their production, which also means that you can basically, you don't take into account the order in which the scenarios, the states of nature occur. And but if they are not perfectly flexible, then the order in which you have your states of nature becomes relevant in order to determine the prices. So do you think this is relevant to your analysis, to your results, if you make your generators less flexible, or do you think your results are robust to that?
I didn't quite understand your question. Was that with regards to the order of merit, where we ask which generator to know?
Now, it's because you have your different states of nature and you have the expected price associated to each state, but you derive the expected price assuming that each state of nature is independent one from another. Mm-hmm. But if you have inflexible conventional generation, then you might have links between your different periods, different states of nature, which will influence then the price, the equilibrium price, and maybe have negative prices or surpluses. So to which extent do you think that could impact your results?
I have not tested it yet, but yes, I think that with the fact that I've made the assumption that my my conventional generators are purely flexible, I had in mind, you know, like gas power plants, which take like less time to for ramping up, and then they can activate like quickly compared to coal power plants. So it's true that I've not taken into consideration inflexibility to make, you know, one state being dependent on the other or things like that. But maybe what I had at the back of my mind, which I've not taken into consideration here, for example, is that in my model, there can be some kind of contract which can act, you know, like a storage contract, where in fact, when there is surplus of production, then this contract like takes this surplus and it can like fulfill the other states of nature when we do not have enough electricity. So that's how maybe I can answer to the question of not of conventional technologies being not as fully flexible as we want them to be, but we can think about when there are surplus of production, then one contract can act like a storage contract for another state of nature. So what this is what I had at the back of my mind, but if you have any suggestions of how I can take that into consideration, I would be most glad.
Well, I don't know, maybe she could differentiate between a subset of flexible and a subset of unflexible generators, and see if it's not too much calculations and computations, because your model is already very intricate and complex. So, but yeah, it was very interesting anyway.
Okay.
But just a question I was asking
I
myself.
try to do that, yes, because here I've just like modeled by a representative agent representing the conventional technology, but maybe we can think about two producers now who can act as producers of flexible and non-flexible technologies. Yeah, thank you very much for the comments.
Thank you.
Okay, thank you. Thank you very much to everybody for those interesting presentations. Time is gone. And have a nice day, night, evening. I don't know.
The day has started here, so it's only 9.
Thank you very much.
Thank you. Once again, don't forget for the speakers to upload your presentations on the dashboard.
Yes.
Thank you.
Thank you very much.
Thank you.
Bye-bye.
Bye-bye.
Thank you. Bye-bye.
Bye.